Hi everyone, let's talk about accounting. What is it? What is the need of accounting and what are its types? It is an information science. When we talk about science, science is actually a series of steps that requires adherence. We need to follow them strictly. When we talk about information, it's about financial information. Financial information that pertains to individuals and organizations. What is a financial information? Financial information actually is a information regarding the business and its finance. Finance is generated through business activities, and activities are selling, buying, also trade, manufacturing. These all are the activities that generate finance. Let's talk about them in detail. Information science requires collecting, organizing, and analyzing the information. As we have discussed before, these are the series of steps and series of steps. But what type of information? The information is a financial information, as we have discussed before. The finance is in the terms of money, and money is calculated in terms of numbers. So it's a quantitative nature of study. Accounting is actually a practical science. It's not an abstract science. The more you will do it, the more you will become better. It is for the individuals and the organizations. It is actually the last part of the definition we have gone through in the first slide. Individuals and organizations. Organizations have a loads of data. They have a lot of data. They have huge amount of transactions. That means that the financial data will be immense as well. So that needs to be organized. They need to organize the financial information for their businesses. How much products they have sold, how much the raw material they have purchased to create a product and then selling that. These are the kinds of information needed to be organized in a better way. How much funds they are left with. This is also an important point because business have the budgets. They need to allocate various amount of budgets to various amount of activities. They need to have a hawk's eye on their wallet as well in this regard. For the individuals, when the individuals are doing the businesses, they might have a lesser amount of transactions, but still they need to be organized. They need to be aware of their personal finances. They need to pay attention how much the income is coming in and how much the expenses are going out. Let us discuss accounting in terms of time. Accounting is actually the information of the past. When we say this statement, that means we are talking about the events that has been incurred. As they has been incurred, they are the past. For example, the sale contract is executed. The sale is done and the cash has come in the business. So it's an event that is already being performed in the past. So this past event has to be recorded in the present. We will record it if we are following, yes, we are following the double entry system, then we will record the cash as debit and the sale as credit. This is a present recording of the transaction, and this recording of the transaction will have an impact in the future because this double entry will be translated into the financial statements. Bookkeeping is actually a first main area of accounting, and this bookkeeping is a partial component of financial accounting. Financial accounting is actually the second main area of accounting. The first area, bookkeeping, requires a bookkeeper to record the information, to record the transactions incurred regarding the business. For example, the sale, the purchase, the amount of activities, the trade, the manufacturing, the list of the payables, the list of the receivables. These all are something being recorded by the bookkeeper. He is the custodian of records that is relevant to the business itself. As I have said, it's a partial component of financial accounting. Financial accounting itself utilize this bookkeeping information, organize it for the external stakeholders Let me explain it with an example. Financial accounting will take the information from the bookkeeping. The bookkeeper has recorded some of the information, and financial accounting will translate that information into the financial statements. The three type of financial statements: income statement, balance sheet, cash flow statement. There are other sort of financial statements as well, but broadly there are three. And these financial statements will reflect the situation of a business, whether it's going good or going bad. And this sort of information will be viewed by the external stakeholders. For example, the investor, when he have to invest in a certain business, he have this information of the business. He will view this and take a decision whether to go for it or whether to refrain from it. Let us talk one by one about each of these statements in a brief manner. Income statement has the details of income and expenses. Income is generated through the business activity, that is most probably the sale, the manufacturing as well, and the trade also. Trade also requires the sale. Income and expenses, the details of that is in the income statement. It is prepared for the company's ownership. The owner has to view it as well to know how the company is progressing. The lenders, financial analysts, and external stakeholders. Balance sheet is actually the detail of assets, liabilities, and capital. Assets and collectively, these three depicts how the business is doing at a particular point of time. At a particular point of time, for instance, 21st of September, the situation of the balance sheet is: assets are 1 lakh, liabilities are 50,000, and capital is also 50,000. That shows a situation of a business at a particular point of time. Particular point of time, this is actually a snapshot of a business, a particular picture of a business. When we take a picture, that picture is actually portraying the situation of that particular situation, the particular point of time. Whereas the income statement is not a point or in time approach, it's a period in time. Let's proceed. Cash flow statement is actually the details of inflow and outflow. What amount of money is coming out, what amount of money is coming in, and what amount of money is going out. Financial accounting. Financial accounting continued. Financial accounting continued. Actually, financial accounting requires certain principles to be followed and strictly following them. For example, accounting principles may be separate entity principle. It also includes matching principle. There are many, so you have to follow them. Also, there are international accounting standards, international financial reporting standards that require another dedicated video. So we'll talk about it in some other video. By viewing these statements, the investor have the idea how much the sale is being done by the business. So that sale is actually depicted in income statement. How the business is financed, as I have mentioned before, when we view the balance sheet, we came to know what is the capital and what are the liabilities. Liabilities itself depicts how much the loan we have taken. So if the loan is higher, so that means our business is financed through a riskier ways. That will obviously discourage the investor himself. Was the business profitable? The business profitability we can observe through income statement. How much income we have generated and how much expenses have incurred. So when we have a net effect of that, we find the profit. If the profit is more, then the business profit is profitable, and if the profit are less, then profitability is less. What is the cash position of the business? Cash flow statements actually tells the cash position of the business. Managerial accounting. Managerial accounting is actually for the insiders. It's an insider information, and it is supposedly shouldn't leaked out to external people. For example, for competitors, Your external information might be you are about to launch a new product, and if it gets leaks out to the competitor, they may have a counter strategy to launch a similar product or a better product. Your internal research and development methodologies, these are also confidential. Your management style, this is also this is also confidential. These principles should be managerial accounting. The third area, that is managerial accounting. Managerial accounting is actually for the insiders. It shouldn't be leaked out to external stakeholders. For example, you are developing a certain product, so it's an insider information. If it gets leaked out to any external competitor, they might formulate a counter strategy and create a better product than you, and obviously this will be a hit to your business. Other examples might be the management style a company is following, and it is an effective style, and you don't want others to copy it. This is also a managerial accounting, managerial information. It does not require any accounting principles. As we have mentioned before, financial accounting required accounting principles to be followed, like matching principle, separate business entity principle, accrual concept, etc., etc. This doesn't require all of this. You can customize your principles according to the need of your organization, need and nature of your organization. They are more detailed than financial accounting. Obviously, they are more detailed because every organization has designed them according to their own feasibility. It contained strategic information that shouldn't be seen by other competitors. Strategic information means information that is relevant to the long term strategy. That may include pricing, competition, marginality, and budgeting. Pricing itself is a huge topic. All of these four are huge topics, a subject in themselves. These information are highly confidential and also under the umbrella of managerial accounting. Keeping in mind the managerial accounting and financial accounting are interrelated, and they complement each other. Tax accounting. Tax accounting requires methods how to file tax returns in accordance with regulations and tax laws. So it also requires how to determine the taxable income and also tax liability, the calculation of tax liability, how to minimize your tax liability as much as possible according to the rules and regulations, obviously. These require many things: tax evasion and tax avoidance. Tax evasion actually is illegal, and tax avoidance is not illegal. It is managing your tax liability by utilizing the rules and regulations. This is a huge subject itself, but our main focus is in the financial accounting itself. Let us sum up this video and call it a day. I'll meet you in another video. Till then, please take care of yourselves, and it's Allah Hafiz from me. Bye.